How is everybody doing today? Welcome back to another episode of The Banker Next Door. I am your host, Dr. Joe Berquist. Today, I wanted to talk to everybody about the rising cost of small business lending and what can banks do to try to help small to medium-sized businesses in basically their lending needs, helping them get the capital that they need to run their business, grow their business, and try to just make things better overall. So we're going to be looking today at a blog post from PCBB, and this is titled The Rising Cost of Small Business Borrowing, How CFIs Can Help. And the summary here reads, with the Federal Reserve holding rates steady, small to medium-sized businesses continue to face high borrowing costs and tight lending standards that limit access to traditional financing. We basically take a look at how CFIs or banks can offer tailored solutions. So small and medium-sized businesses still need affordable capital, but high interest rates, inflation, and tightening regulations are making the cost of borrowing prohibitive. For banks who want to meet these businesses' needs, the evolving small to medium-sized business lending environment presents an opportunity to flex their relationship-building muscles by offering personalized loan structures, faster approval processes, and fintech partnerships. Banks can help small businesses access the capital they need while differentiating themselves from larger banks and non-bank lenders. So first, it starts off by talking about there is a shift toward alternative lending. The growing demand for small to medium-sized business financing is evident in the increased volume of SBA loan approvals over the past few years, with SBA loan volume rising 22% year over year in 2024. Despite this growth, there are far more small to medium-sized businesses that would like financing but feel too discouraged to apply. About 44% of them did not even apply for loans last year because they believed they would either not qualify or be denied due to the current tightened lending standards. Many small to medium-sized businesses are unable to access SBA loans due to several challenges: slow processing times, 30 to 90 days, maybe even 120, strict eligibility criteria, high fees and interest rates compared to alternative lenders. Yes, SBA loans are not cheap, and I do not recommend them to a lot of people. I really think it depends on the circumstances. With the rate and the fees that get charged by SBA, they're not. Sometimes they're a necessary evil. Sometimes it's too expensive. But to continue on here, so while the total approved loan amounts for SBA loans have increased, the application process remains lengthy, and many businesses face difficulties meeting the qualification requirements. As a result, many small to medium-sized businesses are turning to alternative lenders, such as fintechs and non-bank lenders, even though those have their own disadvantages compared to traditional bank loans. Non-bank lenders tend to charge higher fees than traditional bank loans, with interest rates ranging from 3% to over 60%. Depending on the type of loan. Despite the high cost, however, many small to medium-sized businesses feel they have no choice but to rely on alternative options, as SBA and traditional loans remain out of reach for the vast majority. And then we get into small business lending challenges. But before we go into that, I just want to say something on the non-bank lenders. So if you use somebody like PayPal or an On Deck or a Blue, PayPal may not be as bad, but like on Blue Vine, On Deck, Cabbage, some of these other some of these other players that are out there. I mean, the interest rates that they can charge and the fees can be absolutely insane. It can be totally absorbent. And the way that they charge people. So say, for example, you had to borrow $100,000. Now here's the plus. The plus is they have very good websites, very streamlined. You go on there, you apply, you upload your financials, you upload your other information, and you're probably getting an approval very quickly. Maybe less than an hour, maybe within 24 hours, whatever the case may be, but you're getting an approval very quickly, and you will have the money the next day. They'll send you, basically it's like, oh, hey, here, we'll send you a bunch of loan documents, you e-sign it, you send it back to us, and then the next day, boom, you have your money in your account. So that's all great. Then the problem comes to then the fees come. Oh, here's all the fees for the loan. And oh, here's the 60%, 70% interest rate that we're going to charge you. And then, oh, by the way, that $100,000 has to be paid back to us within 12 months or maybe 18 months at the longest. And oh, by the way, we're going to be taking not a once a month loan payment. We're going to be taking money out of your account every week. And it's going to be, the $100,000 or, repay $100,000 over 18 months. I mean, it's going to be, $3,000, $4,000, maybe no more than that on a monthly basis. So I mean, you're talking about probably $1,000 plus dollars a week coming out of your deposit account. A lot of businesses don't have the cash flow for that, so it leads to that can lead to a lot. I've seen it lead to a lot of issues with businesses who you can get that money real quick, but then they don't really contemplate what happens on the back end after they have the money. So sometimes it works and sometimes it causes a lot of issues. So, but anyway, okay, so let's continue on here. Those small business lending challenges. So given the barriers to accessing traditional financing, many small to medium-sized businesses hesitate to take on new debt. A recent payments intelligence survey reveals why. 35.4% cite higher fees and interest rates as the biggest obstacle, while 19.2% point to difficulty meeting eligibility criteria. Additional barriers include low credit limits, 13.9%, and high repayment amounts, 13.8%, explaining why traditional financing options like SBA loans remain out of reach for most. And then, so here we have this interesting chart here. Says why SMBs are not using credit. Again, high fees and our interest rates, 35%, did not need to use credit or borrowing tools. So 34% didn't need, they didn't need to borrow money. Eligibility criteria to meet, 19.2%. So basically you've got about almost like 55% of people are saying that they can't meet the eligibility requirement or the fees and the interest rates are too high. Debt-related issues that they already have, lower credit limits than what were needed. So in other words, somebody says, hey, I need 75,000, but they only get approved for 25. High repayment amounts, 13.8%. Not enough options offered as part of the payment process. Short repayment time frame. Our primary bank not offering suitable credit products. And then about 8.8%. And then unclear or hidden terms and conditions. So, but again, I would suspect that the ineligible criteria to meet, I would assume, what are some of the things that would fall into that category? Obviously, not being in business for at least 2 years. And that's not just being in business for 2 years. That's 2 full years of operation with 2 years of tax returns that you can give to the bank. So sometimes you have to be, you might need to be in operation for, 2.5 years before you get those 2 full years of completed tax returns. But that in and of itself is not enough. You also have to be able to show profitability, because if a bank, remember, the number one issue for any bank in underwriting is cash flow. If you cannot show cash flow, if you cannot show the ability to repay whatever the debt is that the bank is going to give you, the bank is not going to be able to approve that loan. It's just that simple. So the bank, in terms of good, prudent underwriting status, they're looking for a minimum of 2 years in operation, and you have to show profitability. Now, and for 99% of companies out there, usually their first 2 years are not going to look that great, especially their first year. They're absolutely, 99% of companies lose money the first year in business. And usually year 2 is an improvement, but still not that hot. Usually, for most companies, it's not until their 3rd, 4th year in business that they really start to turn the corner and things really start to look a lot better. So that, my guess is that for the people that, eligibility criteria difficult to meet, my guess is those are the issues that are kind of falling into those categories. So what does it say here? And then it says assessing financing quickly is also a critical issue for many SMBs. The average time to find a loan varies significantly depending on the lender. While traditional banks can take anywhere from 60 to 90 days, online and alternative lenders can fund loans and as few as 1 to 7 days. This stark contrast in loan processing times is one of the key reasons many SMBs are opting for faster alternative lenders despite higher costs. Indeed, the 2024 Small Business Credit Survey found that only 14.6% of loans were approved by big banks, in no small part due to overly long processing times. For businesses operating on tight margins or in seasonal industries, long wait times for loan approvals are simply not feasible. So how can banks help to stand out in the evolving landscape? Well, there's a number of things they can do. So they could try to, number one, personalize loan structures. Number two, faster approval processes. Number three, leverage technology and data. And then number four, focus on underserved sectors. So then let's chat. So there's a number of things that can be done here, but none of these things are easy. And what do I mean by that? Like, well, personalize the loan structures. I think that community banks already do a pretty good job of that. That's why community banks continue to be the go-to for small to medium-sized businesses, because they cater more to these customers and they do a better job of building relationships with these customers than the big banks do. Faster approval processes, that gets tough, because it also ties in with leveraging technology and data, right? Like, you could create an automated loan process, but that is also very expensive and very time consuming to do. And there can be a lot of hiccups in trying to implement that. And, it's not like an easy plug and play. It's not like, oh, hey, I'm going to download Microsoft 365 and in an hour I'm going to be up and running. No, it's more of a 1 to 2 year process with a lot of hiccups along the way and a lot of setbacks, and it can get very cumbersome and very difficult. Focusing on the underserved sectors, that could help, but but that also depends on what is the strategy, what's the niche, what's the focus of your bank. Sometimes that works and sometimes it doesn't. Like I said, it all depends on the strategy of the bank and what they're trying to do. Also depends on a lot of regulatory, compliance issues as well. So, but again, this is one of those issues we're going to have to keep a close eye on. I wanted to show this just because I wanted to kind of point, well, what are small business lenders? What are the difficulties they're dealing with today? What are some of the things that are going on? And what are some of the things that banks can do to maybe try to help them out in this regard a little bit? So, but anyway, we'll continue to keep an eye on this and see what happens with this in the future. But with that, I will wrap up by saying, if you like this episode, please make sure to like, share, and subscribe. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please be sure to leave your comments down below. And as always, make sure to check out some of the other content on the channel. I hope everyone has a great day out there, and I will see everyone again real soon. Thanks a lot.